come to the final part of our discussion on Unit 2, which is on investments and various asset classes that are available with us. We've already looked at the various savings instruments and equity and debt. Now we're going to talk about real estate. We're going to talk about which is basically land and apartments, etc. We're going to talk about commodities. Primarily, the investment in commodities would be happening on account of gold or silver. These are the major two precious metals in which people invest. There could be other agri commodities as well, where people invest in order to kind of make money there. And then we will also look at alternative investments which are available. So alternatives which are available there, right? So let's begin first with our understanding on real estate markets, right? Now, when you look at real estate as a segment, you could invest in commercial real estate, which is all the malls that we see around us, which is all the offices that we see around us. Basically, anything to do with commercial or business activity is what would come under commercial real estate, right? You could invest in what is called as residential real estate, which is you could buy a land, you could buy a home, you could buy an apartment, right? So you could buy any of these areas to be clubbed as a residential real estate investor. And then there could be real estate funds. These funds could be in the form of either pooling of resources or some sort of a small or even international funds come in this, where you would pool money and then go ahead and buy real estate, and that could be either commercial real estate or residential real estate, right? The real estate funds bit is not very popular at this point of time in India. What is going to come at some point of time is something called as real estate investment trusts. That's called as real estate investment trust. These will come up, which are in a sense what real estate funds are. Otherwise, today real estate funds are primarily operated as alternative investments in India, which would come under what is called as a private equity fund. So we'll look at that separately. Now, primarily the rates that you typically find, right? So in terms of the rates that you find on real estate, usually the commercial real estate rates are greater than the residential real estate rate in the same area or the same city. So in the same geographical locality, you will find that the residential rates are cheaper or lesser expensive as compared to the commercial rates, right? Now, real estate markets globally have long cycles. When we say long cycles, these are very different kind of markets where there is no real marketplace, right? So there is a problem in terms of liquidity, which is because the transaction is between two parties without the involvement of an exchange, right? So without an exchange. Now, because there is no exchange, whatever price one party is willing to pay to the other party is basically the price at which real estate transactions take place, right? What happens because of that is typically cycles become long because information flow in these markets is slow. Information flow is slow, right? So if I sell a piece of land which is at a lower price than the market rate, this information does not flow very quickly into the market, right? What that does is that the market price does not fall so easily because of the cycles that get created. Typically, for a long period, you'll see prices going up. Then for a long period, you'll either see them stagnating at a particular level or going down as well from that particular level, right? Some broad statistics around the real estate markets in India today and where is it kind of going to go. So the total real estate market in India is US dollar close to about $100 billion, and that's expected to basically double in the next 5 years or so, right? The shortage of houses today in India put together in urban and rural areas is close to 40 million houses. We need 4 crore houses that need to be built. This is the shortage. By 2020, we will possibly have created the shortage to go down to something like 32 million. So we would have given about 8 million homes in between. The government is actually planning to give even more. The government plans that by 2022 there would be a scenario what is called as housing for all. Right. So basically, once you reach that housing for all kind of a scenario, what would end up happening is essentially the government would have ensured that the housing shortage would go down. Now, the other interesting part which we have, and that comes from the source website, is if we divide the total market into three groups: high group, middle income, and low income group. Primarily, the demand in India in housing comes from the middle and low income groups, right? Primarily, the supply here. So this is demand and supply, they match here. 17% supply, 19% demand, right? In the second case, supply, so this is an oversupply scenario where supply is 61% but demand is only 41%. So this is an oversupply scenario, and this has resulted in the market becoming stagnant, right? On the lower income group, there is a undersupply, right? So people want houses that cost less than, let's say, 20 lakhs, 25 lakhs, 30 lakhs, but there is very little supply at that end because that doesn't appear to be profitable for the real estate developers. So when you look at the demand supply scenario, the demand is highest in the middle income group, but so is the supply. Now, ideally, the demand is very also fairly high in the low income group, but there is low supply here. This is an opportunity if you think about it from the perspective of a real estate developer. Essentially, if someone was willing to make houses for the low income group, there should be an absolutely ready demand for this segment, right? On the contrary, if you're going to make houses for the mid income or higher income group, the demand is not so readily available. When you look around yourself in terms of who are the major real estate players in India today, most of them are catering towards this segment, the top two. Whereas ideally, it makes complete business sense to cater to the low income group segment in terms of demand supply scenario or economics, right? Now, how do you generate income in terms of real estate? Typically, you will see that real estate, the first and primary inherent assumption is that capital appreciation happens. So when you sell property at a higher price than purchase, the return generated is called as capital appreciation. For the last nearly 30 years, India has seen a big capital appreciation, right? In the last 10 years also, return generated through real estate is more than the stock market, and the stock market returns over the last 10 years are around 16% or something. So that's primarily the motive of why people buy real estate in India, is because they believe prices will keep going up when you look at something like a real estate market. That's however not true globally, where you have ample examples such as Japan, such as US, such as Iceland, where prices have basically fallen over sustainably long periods of time, right? But India hasn't seen that cycle as yet or detailed cycle as yet, so we keep believing that the real estate segment will keep seeing some sort of a capital appreciation. Right. The second way, where globally a lot of the people invest in real estate for something known as a rental yield. If you think about rental yield, it is very similar to what is called as the dividend yield, right? Which is effectively the formula for rental yield is the rent you generate on an annual basis. So what is the annual rent? You divide that by the purchase price, right? So what is the amount of return you are making if you buy the property at a certain rate, right? So if your property is bought at 1 crore and you get a rent of 10,000 every month, giving you 1.2 lakhs a year, your rental yield is going to be 1.2%. That's 1,20,000 of rent divided by the property price of 1 crore, right? At present, typically pan India, your residential rental yields would hover around 2 to 3%, and commercial property hovers around 4 to 5%. right? So those are the rental yields that come up if you look at the longer term tenure at this point of time. Now, are 2%, 3% rates good? Is this 2% or 3% good? We're going to look at that now, right? So broadly, that's the key market, right? Now, think about it. The first way, that if there is no capital appreciation for a moment, there is no capital appreciation, right? Then what are you going to play on? You're going to make 2 to 3% return at this point of time on account of rental yield, right? Now, if prices do not go up, then both ways there is a problem. Problem one is you could have used this 1 crore rupees if you had this money and put them in a fixed deposit, right? Even a fixed deposit would give you something like 6 to 8% return, right? Of course, the fixed deposit does not give you capital appreciation, but we have assumed that if real estate prices stop going up, then a rental yield of 2 to 3% does not make sense when you can make more than that by doing a simple fixed deposit in a bank. Correct? It makes even lesser sense if you borrow money to buy homes, right? If you borrow money to buy homes, your borrowing happens at anywhere between 8 to 10% cost of interest. And what are you going to make? 2 to 3% return. So effectively, you are earning 2 to 3% on an asset effectively, and you're paying 8 to 10% as a cost, right? So that's the primary issue of real estate investing. In addition, there are a few more risks. The markets tend to be illiquid. There is less information flow. So transactions may not happen immediately. If I want to immediately buy or purchase or sell a particular piece of land or apartment, that might not happen immediately because there's no real market that is running around it. It's between two individuals, right? The cycles are longer in durations. So both up cycles and down cycles can be prolonged. So for 20 years we have had an up cycle. It's fairly possible that for 5, 7, 10 years we have a down cycle. There is no real movement in terms of real estate prices that go higher, right? Also, real estate markets are driven by a lot of debt, both on account of the buyer and on account of the sellers. All major sellers, which is the real estate developers, I should say, run their entire operation with a lot of debt, and that could make downturns as very, very serious and severe in financial terms, right? At this point of time, real estate investing is sort of stagnant. It also requires, in another negative of real estate investing, is it requires high capital. You cannot start investing in real estate directly without having 10, 15, 20 lakh rupees at the minimum, which is not true with stocks. You could buy a stock worth 50 rupees, right? Once real estate funds become very popular in India, then I think that problem will get resolved. So that takes care of the real estate part. Next, we move to what is called as commodities. Now, commodities, we all know what are there. So there could be precious metals, which is basically your gold, silver, etc. Then you could have commodity derivatives, which could be on agri commodity or crude oil, for example, etc. And then could be exchange traded funds. This is ETF, is an exchange traded fund. This could be on either gold, it could be on silver, it could be on oil, it could be on any other index of commodities. This is something we will look at more detail at a later point of time on what this is. But primarily, our focus in terms of understanding how do you make money on commodities, we need to understand that commodities help us make money majorly because of capital appreciation, right? Within this context, India is a country that has extreme affinity to gold. So we will look at the details around gold a little bit. First things that we need to consider is gold prices over the years. So on the left side, you have prices in US dollar. On the right side, you have prices in INR, Indian rupee, right? Now, if you look at the left chart is obviously a longer chart as well, starts in January 1975 and comes up, it's a 45-year-old chart, right? It gives you a few cycles. The first cycle being where Gold prices went from 150 to 750, then stagnated between 1980 somewhere, right? So 1980 somewhere all the way up to 2000, where prices went back to $300. Then there was a big up move that started from 300 and went all the way up to 1900 in 2010-11, and since then prices have come down again and now it's close to 1300 again, right? So gold has had big movements in terms of prices moving, 150 becoming 750, then 300 becoming 1800, 1900, 1900 becoming 1300. That's the scenario. What is important, however, is you typically have a gold price in US dollar and then you convert it to INR in India. What that does is if you are converting US dollar to INR at 50, so let's say the price was dollars 1000, you multiply with 50. That gives you the price in India as 50,000. Now let's say gold price falls from 1000 to 900, but 50 goes to 60. The currency conversion in India goes up. You could actually see a price increase in Indian terms even when global price has fallen, right? Why? Because currency movements could change things. Now, if you want to look at the impact of, take a look at this period where gold prices fell from 1900 all the way up to close to about 1250. That's nearly, if you think about it, 1900 going to 1250 is going to be close to a 30-35% cut in prices. But during the same period, 2011 to 12, you will see India's prices were around 90,000 in rupee terms, and they fell only to something like 70,000, which was about a 20% cut. In fact, between that high and now, we have not really seen prices dip too much. Maybe a 10% kind of a dip is what we have seen. Why is that? Is because in 2010, INR to USD was 50, and in 2016, INR to USD is 67. So this is one important trait of gold, that gold preserves the value. Gold preserves the value of your money in dollar terms. So even if your currency falls, you actually make money on that account because gold prices are denominated in dollars, and then when converted to rupees, if 50 becomes 67 in terms of rupees, that's good for gold. Gold prices actually go up in that context. So that's going to be the primary way you make money on gold, which is capital appreciation. Let's look at some more data in terms of what is happening with the gold. This data is in terms of tons, and data has been taken from World Gold Council data. India's total gold reserve is 557 tons, right? World jewelry demand is essentially 596. India is one of the biggest, the largest being China. This is India being one of the biggest, and then there is a demand in terms of investment. How does investment happen? People buy gold as an investment instrument, and if you look at this and this combined, that's a big chunk of the demand that comes in, and that's primarily India is the second largest user of gold, right? In that context, in terms of demand that comes in. So that's broadly the key to understand that as a country, we have a lot of affinity to gold that has repercussions on our foreign exchange reserves. But in reality, what that does is that in from investors' perspective, it's an instrument that saves money in the dollar terms, even if your rupee rate versus the dollar rate depreciates. Right? It's generally considered an instrument which is a safe instrument. Gold is something that you can use all over the world, correct? It's a physical asset, so there is a risk in the sense that security is a concern. It could get stolen, for example. Now, when you sell the metal at a higher price than purchase, that's your capital appreciation. Historically, it has been seen that metals have negative correlation with stock markets. Why is it considered a safe instrument? Is because when stock markets fall, usually gold goes up. Because people are trying to buy gold as a safe instrument, the gold prices actually go up when stock market is falling, right? In terms of returns are typically in the range of 7 to 9% over predominantly long periods, but in some shorter periods you could make more money, right? How can you make more money in gold? In India, government of India has actually launched multiple initiatives to curb the physical consumption of gold. Why? Is because we import all our gold, and when we import gold, it increases the import bill and eventually creates a problem in terms of the deficits that we have. So India has a sovereign gold bond at this point of time, what is called as the sovereign gold bond. In addition to the gold price movement, it gives you another 2.5% annually. So if you buy the gold bond and currently gold price is 10,000 and this goes to 15,000 over 3 years, in addition to the 50% return that you've made here, you will get another 7.5% for 3 years. Why? Is because 2.5% gets added in that gold bond. And the idea is that the government will give you this money, but they will not buy physical gold for you in this context, right? That's the other way you can generate income through precious metals. Now, all other instruments also in the commodity space work similarly. We next move to other alternative investment options. The first one is private equity, which is similar to your equity market, just that it does in private companies and usually smaller companies, because most of the larger companies become publicly listed companies. Private companies are usually smaller in size, they have less transparency, right? So there is a risk that comes up because of those data points in terms of private equity. Worldwide, interestingly, there is also something called as collectibles. People collect art, for example, paintings, and there is a buying and selling that happens in paintings. And if you sell a painting at a higher price than what you bought, that's considered capital appreciation. We'll also be surprised to know that similar collections happen with wine as well. So art, wine, these things are considered as collectibles. People buy them, keep them for 10, 15, 20 years, and then they could make a capital appreciation based on that, right? Having said that, there is a little bit of a problem with respect to alternatives. What is the problem? They are illiquid. You cannot get in and get out of a painting or wine so easily. You wouldn't find a buyer most of the time. So that's a big risk, right? Second, they are not transparent. Not transparent in the sense that if you're investing in a private equity firm, that will in turn invest in smaller companies that are not as transparent as some of the publicly listed equities or bonds that are available. Secondly, if you look at art or wine, you do not know how exactly to value, right? You could value art at so I could like a painting more than you. I would be willing to pay more for the same painting than you. That doesn't help. That makes things difficult in that context, right? Same is the case with wine. So how exactly do you value collectibles is not known, and these are some of the key risks or problems with alternatives investments. So typically you will find that alternatives would only be looked by HNIs and ultra HNIs, ultra high net worth individuals who have a lot of money. They have investments across all the other asset classes. They will then go and look at art and wine as collections or private equity as an investment opportunity, right? So let's kind of summarize what we have done so far in terms of your risk and reward perspectives in the order of increasing risk on the side from left to right, and in the order of increasing returns from left to right. You start with cash, which is the safest instrument, then government bonds, which are considered safe, corporate bonds for major corporates, and typically here we would include AAA, AA, these kind of bonds. They are the next one. Real estate and gold typically come here, but there is no clear cut idea in terms of, so usually they are considered safer because prices don't fall dramatically in real estate, and gold is considered safer because it's a globally acceptable commodity. Equity markets typically tend to be volatile, so they are at the higher end of risk spectrum. And because alternatives are not really easy to value, right? So we don't know how to value them, and they are extremely illiquid. We keep alternatives at a higher risk proposition, right? Also, by the same corollary, alternatives are also invested in by ultra HNIs. So typically, as the risk perception of an individual increases, the individual would move outwards, right? Risk tolerance increases, then you will look for investments on the right side. If risk tolerance decreases, you will look for investments on the left side. That is primarily the risk and reward perspective of all the major asset classes and investment avenues that we have seen. Let's close this particular section with a few questions. Create a broad diagram to show the risk reward of various instruments available for investment. What are the key benefits of investing in gold? And what are the various ways you can make money in real estate investments? Thank you.